Okay, Chapter 5, we're going to be looking at gross income and exclusions. Specifically, we're going to be talking about the realization of income and explain when taxpayers recognize gross income. We understand the distinction between the various sources of income, including what income from services is and income from property. And then we're going to apply some basic income exclusion provisions to compute gross income. So let's get right into it. Gross income. Realization and recognition of it. So taxpayers report realized and recognized income on their tax return for the year. Now, some income is excluded or deferred and is not included in gross income. We've talked about that. Excluded income, remember, is never taxed. Deferred income is only taxed in a subsequent year. So what is gross income according to the law? Well, there's Code Section 61A of the Internal Revenue Code. And it starts with except as provided. So you have an exception already. Except as provided. Gross income means all income from whatever source derived. So that's basically saying unless you could find somewhere where the code section said it's not included, it's included. So it's excluded by exception, by law. Regulation 1.61 further explains and justifies the definition of this includes income realized in any form, whether in money, property, or services. So what they're saying here is you can't say, oh, that person paid me with their car. I don't have to include anything in income. I only have to include it if it's cash. That's not true. So if you receive property in a taxable transaction, you recognize the value of that on your tax return as income. Or even services. For example, if you're in business and say you do tax returns, that's your business, and you know someone who cleans furnaces, and you say to them, clean my furnace and I'll do your tax return in a barter transaction. You value those services and include the value of those services on your tax return. You don't say, no income, it was barter. No, that's not how that works. Even in trade, you value the services, value the property, or then you have the actual money. So taxpayers will recognize income when they receive an economic benefit. And this is on page, let me grab the page. 5-3 of your book. So it could be receive compensation from working, you receive proceeds from selling a product or selling an investment. Also, people will say, well, what happens when I get a loan? Because I received an economic benefit if I get cash or I bought something with a loan. And the answer there is no. You do not have, that's not considered part of this because you have to pay it back. So if you didn't have to pay it back, that would be different. But because you have to pay that loan back, it's not looked at as being a recognized income item. They realize the income. So when you receive an economic benefit, that income, you realize it, and then the tax law will let you know if you can exclude it, like I was just talking about, or deferring it. And there's your economic benefit. The realization principle is when they're saying basically you've got something. It actually happened. So the taxpayer engages in a transaction with another party and there's a measurable change in property rights because of it. So things like you received money, you received property, you got a dividend, you've got interest income, you received money for services. So there's something that actually happened that changed your property rights. It's a measurable change. Generally, then realized income is also assumed then to be recognized, unless it's excluded or deferred somewhere else in the tax law. Again, remember what I said, the form of receipt does not matter. It doesn't matter if it's cash, property, or services. The other item, there's an important principle called the return of capital principle. So, not all income you receive in a property or in a transaction may be taxable. And here's what we're talking about. Let's say you're selling an asset that you purchased. The cost of that asset is called its tax basis. When you sell, the part of the selling price that can be allocated to the cost basis is not taxed. So when you're computing the amount of income to realize when selling it, you subtract the cost basis. It's because that part of the selling price or the realized income is just a return of your investment or a return of capital, what you originally paid for it. So that part isn't taxed. It's the part above the cost, the gain, that would be taxed. Another concept, recovery amounts previously deducted. Individuals typically claim deductions in the year they pay them, and they're allowed to. So on a tax return, on your federal tax return, if you deduct something in 1 year and get a tax benefit from it, your taxable income decreases. And in the next year, that deduction is reimbursed to you from wherever it originated, you have now what's called a tax benefit. You took a deduction for something and you got the money back. It's like you didn't even pay the money. When that occurs, in the year you get the refund, you include that amount as income on your tax return. Here's an example. Last year, Courtney reported $9,500 in itemized deductions. Remember your tax formula? Gross income less deductions for adjusted gross income equals adjusted gross income. Then we could subtract the greater of itemized deductions or standard deduction. Well, in this case, she deducted the greater amount, $9,500 in itemized deductions. One of those items that are included in that $9,500 was $3,500 of state income taxes she paid during last year. Okay, so last year her employer, let's say, withheld out of her paycheck $3,500 in state income taxes. That's an allowable itemized deduction. In March of this year, when Courtney did her state income tax return, it ended up that she paid in too much during last year and she received a $420 refund of the $3,500 in the state income taxes she paid. So she deducted all $3,500 like she wasn't going to get a refund on her federal tax return, when in reality she got some of that money back. So she shouldn't have deducted all $3,500. She should have deducted $3,080 because that was her actual tax liability. Well, the IRS doesn't say, well, go back and redo your tax return from last year and only deduct $3,080. No. They say, no, you got a benefit. Last year, you deducted that $420 that you got a refund for. So this year, included in your gross income. And actually, if you have a 1040 available, that $420 goes on line 10, I believe, of your 1040. So this is a common thing that happens. Oops, I'm sorry. I was a little wrong there. I forgot about the standard deduction amount. Don't worry about this part of it. It's a little too, we'll get into this more. But just so you could see this. Here's what they're saying here. Her standard deduction amount, so what she would have deducted is $9,300. She got to deduct $9,500. So really, of that $420 refund, it was only a $200 difference because No matter what, you would have deducted 9,300 because of the state income taxes. Let's per se, she got to deduct 9,500, so she only got to deduct an additional $200. So only 200 of the refund would be included in her income. Normally, that's not the case. And if you have any questions on that, please let me know. Post them out on the discussion board. When to recognize income? They generally include it on the individuals included on their tax return for the calendar year. Corporations, I'm not worried about them, but they often have a fiscal year end. The method of accounting generally determines when income is realized and recognized and included in gross income. So let's take a look. Corporations generally use the accrual method of accounting like we do in financial accounting. Not worried about that. We're worried about individuals. Individuals use cash accounting, meaning you include income on your tax return the year you receive the money, or we're going to talk more about that. Generally receive it or constructively receive it, and you deduct when you generally pay it, the year you pay the item. Constructive receipt. So we said generally when you receive the income. Well, if you start thinking about it, people could start playing with that, right? They could say, oh, if somebody owes them money, or like say a customer, somebody buys something off of a business and a customer is going to pay the business. The owner could say, I don't want that income on my tax return this year. Let's pretend it was bought next year. Don't give me the cash till next year. And then they could say, well, I didn't get the cash. I didn't get the cash till the next year. Well, these loopholes were found, and they came up with this other rule that says, well, you either receive it or you constructively receive it. Taxpayers must realize and recognize income when it is actually received or constructively received. Constructively received means this. You had access to the money, so the transaction occurred, and you had the ability to get the money, and there were no restrictions on the money. You just chose not to take it. Okay, so if those two items are part, if they're not available. Sorry, it's 5 o'clock in the morning. If they are present, that's the word. So if those two items are present, you're considered to have received the cash and included in income. Give you an example. You have a customer. It's December 31st. They pay you with a check. You don't deposit it until the next year. There is plenty of money in your customer's checking account to cover the check. When is that income? It's income when you constructively receive it. You received it December 31st. They had plenty of money in their checking account to cover that check. You chose to wait till the next year to deposit it. You should have put it into your checking account on December 31st. Even though it's a check, it's still considered constructively received if the money is available in the customer's checking account. Same situation. If you had gone to the bank and cashed that customer's check, it would have bounced on December 31st because there wasn't enough money in the customer's account. This is a different situation. Now you have a restriction. The money was not available to you. So when you go and deposit it in January, when there is enough money, now it's income in January. So these things can get very hairy and tricky. So you got to look, was the money available and was there any restrictions on it? Claim of right. Income is recognized when there are no restrictions on use of the income. So if you have no obligation to repay, in other words, then you recognize the income when you receive it. So that's why loans generally are not included in income. In addition to determining when taxpayers realize and recognize, it is important to consider who recognizes the income. So this question arises when an income shifting strategy is involved. And people try doing this, and there's actually a very famous case called Lucas versus Earl, and it's called the assignment of income. And I believe what it was, if I'm remembering the court case correctly, um, I think it was Lucas. He was working at a job and he didn't want the income in his name. So he told his employer to put it in his wife's name. Give her his paychecks so it looks like it's her income. And this court case went all the way to the Supreme Court, as I said. And they get these great analogies, but it's called the fruit and the tree analogy. And it's a very famous analogy in taxes. And it basically says this: you cannot pull the fruit off of one tree and say it's from another tree. So the tree would be Earl. The fruit is the income from him providing services. So if you're providing the services, if you own the property, you can't say any income from that is somebody else's. You must recognize that income on your own tax return. You can't separate the two. So there is no, you cannot assign the income. It will come back to the owner, the person who performed the services, etc. Now, it's not saying, I mean, you can have your employer there if they do put it in your wife's name. Go ahead. But here's how the courts look at it. You received the income and then you gifted it to your wife, even though the check is made out to her directly. That's how the courts would look at it. The other assignment is community property, and you could read through that. We do not have community property system in Pennsylvania, and I've actually never dealt with it in my career, but it is an income shifting um, item when people are married with how they recognize income on their tax return. There's the assignment of income again. So taxpayers who earn income from services must recognize the income on their own tax return. If you have property and you receive dividends and interest on that property, it's taxable to the person who actually owns the property. To shift income from property to another person, a taxpayer must also transfer the ownership of the property to the other person. Here's your community property. 9 states, half of the income earned from services of one spouse is included in the gross income of the other spouse. Half of the income from property held as community property, so they own it jointly, is included in the gross income of each spouse. And then property that a spouse brings into a marriage is treated as that spouse's separate property. So if you're involved in a state like that, you'll have this, but I can tell you in Pennsylvania, you won't. We are a common law. So the it's basically whoever earns it, that's who puts it, that's your income. It doesn't matter if you're married or not. Now, the types of income. Income from services. So if you're physically doing something or mentally doing something to earn your income, you are considered earned income. So we're looking at wages from a job. If you're a sole proprietor, the profits, or a partner in a partnership, or a single member LLC. These are all earned income items. Unearned income are more from investment properties, things like your savings account, your stocks, your bonds, sales of investment items, land, jewelry, guns, things like that. Okay, so we've looked at realized recognized income, that some of it may be excluded, and who recognizes it, when they recognize it, and the different accounting methods. Oh, and the type of income. Now let's start looking at where we can exclude income that a person may receive. And the first major area is called annuities. Now, an annuity, all that is, I hear the word annuity all the time. It's describing an investment where you will get a stream of the same dollar amount of payment for the same time period. So $100 monthly for a certain time, $300 every 3 months for a certain period of time. So that's all the word is used to describe. A lot of people look at an annuity as an investment because that's commonly where this occurs. Now, You might want to grab a piece of paper. We're also going to have a example. You need to look at this as the following. Remember that return of capital concept. Okay. When you have an annuity, the person who is receiving these equal payments over an equal period of time must invest, purchase this ability to do that. So they pay in an investment amount. Let's say it's $100,000. So they give, and usually it's like an insurance company or a bank, $100,000 for the right for these equal payments over an equal time period. So when they're receiving, the person receiving these equal payments over equal times, some of it is the money they originally put in to have this right. So it's a return of capital. Now remember what we talked about with return of capital. That part of the payment is not taxed. That part of the payment is you just getting your money back. Now, normally when it's a one-time deal, like a sale, we say what did you sell it for? Minus what's the cost? Blah, there's your gain. But in this case, you're not receiving all the money up front. You're receiving it over time. The IRS doesn't say, well, the first $100,000 of your annuity payments will be tax-free. Nope. They come up with a ratio, and they will exclude a portion of the annuity payments received each year from income. And they call that part of your payment each year a return of capital. And here's how they determine it. They take that investment amount and they divide it by the total amount you'll receive on that annuity. They call that the expected return. So it's the total amount of the payments that will be received. So let's say you're getting $1,000 a month for 10 years. That's what the annuity promises to pay. So you invest $100,000 today into this annuity for the right to receive $1,000 a month for 10 years. Well, that's $12,000 a year, right? Times 10 years. So you're going to receive a total of $120,000. You're going to create a fraction. And that's what the bottom formula. We need to figure out how much of the payments each year are excluded. They're considered a return of capital. And we do this by this ratio. We take our original investment of $100,000 and we divide it by that $120,000 we expect to receive. So that portion, or 83%, is considered 83% of our $12,000 each year is considered a return of capital. So that portion is not taxed. So 17%, the other 17% is included. So if you take 12,000 times 17%, that will be the amount that is included in income each year. So a portion is excluded, a portion is included. Here's another example. Graham purchased an annuity for $99,000. There's the investment. Pays her $10,000 a year for the next 15 years. So her total amount will be $150,000. How much of each $10,000 payment should Graham include in her income? Well, 66% is excluded. So 34% would be included, the other 34%. The 100% number being 10,000, 66% or 6,600 would be excluded. So 3,400 would be included. Now, that is a really straightforward example because we know how long you're going to receive the payments. But what happens if it says the annuities are going to be over a life? For example, what if Graham up there purchased an annuity, $10,000 a year for the rest of her life? Because sometimes that's how annuities are written. Now you don't have a definitive time period. Well, the IRS has used tables to determine the life expectancy of the taxpayer when they start receiving the annuity. And based on that life expectancy, we'll come up with the expected return, or how much that amount will be they'll receive over their life, to determine the exclusion and inclusion ratio. Take a look. I want to look at a quick example with you. On page 5-12. Okay, and there is the table. So what we're saying in that, before I get into property dispositions, what we're saying in that bottom bullet point is this. You're still going to take the original investment in your numerator. But when you're calculating the expected return, how much Graham, let's say, is going to receive over her whole life, we have to say, how old is Graham when she starts receiving her $10,000 a year? So let's say she's 70 years old. Well, the expected return is 16 years. So we would take that 10,000 times 16 to determine how much of each payment is excluded and how much would be included on her tax return each year, because it's not defined in the contract itself. Property dispositions. We've talked about this already. Taxpayers usually realize a gain or loss when disposing of an asset. Taxpayers are allowed to recover their investment in property before they realize any gain, and that's generally because it happens all at once. So we take the sale proceeds, so what we received, minus any selling expenses you might have had. You had to pay a commission to the stockbroker to sell your stock. That's an example. And that's what we call the amount realized. Amount realized. We then subtract the tax basis, and that's normally the investment. Now, we may add or subtract to those things, but for now, that's how you have to look at that. And if it's a positive amount, you made a gain. You sold it for a profit. If it's a negative amount, you sold it at a loss. So you sold it for less than what you were originally invested in it. So we must calculate those gains and losses depending on the type of property. We would then put it on the tax return, and we have chapters on all of that. So we just want to get a general feel for how we calculate the gain or loss. Other sources of gross income other than wages or business and property. Income from flow-through entities. So an individual may invest in various business entities. For instance, they could be a partner in a partnership. They could be a shareholder in an S corporation. Okay. In the legal form of the business affects how the income it generated by the business is taxed. A partnership and an S corporation are special entities. They report the entity itself, the partnership and the S corporation, create their own tax return. For a partnership, it's a 1065. You could look it up on the IRS's website. And for an S corporation, it's an 1120S. And all these tax returns are showing the IRS is detailed information about how the business operated. It's showing them the revenue and expenses and what the overall profit or loss was in the business. There's no taxing being done to the partnership or the S corporation. So those entities do not pay income tax. What they do is report the income or loss to the partners and shareholders. They use a special form. It's called a K1. So if you're a shareholder in an S corp and you own 10% of the S corp, 10% of the profit or loss will be reported to you on a K1. Same with the partnership. And then you put the profit or loss from the partnership or S corporation on your individual tax return, and the shareholder, you, pays income tax on it. And this would go, it ultimately ends up on line 17 of the 1040. So you can see there, it says rental real estate, royalties, partnership, S corporations. So we call these flow through entities because the entity itself does not pay the taxes. The shareholder or the partner, the owner, pays the taxes on the profits or deducts the loss on their personal tax return. Now, if you say, well, that's not fair because what happens when they take money out? Well, just as long as they're only taking out the amount of money that they've been taxed on, the profits, it's tax free to the owner. Alimony. For tax purposes, this is important. Anybody could call anything alimony, but for tax purposes, here's what alimony is. It's a transfer of cash, cash only. No property, so the house, the car, the investments, not nada. It must be in cash. And it's made under a written separation agreement or divorce decree that's recognized by the courts. In the separation or divorce decree, it does not designate the payment as a non-alimony payment. So it cannot say it's not alimony. It doesn't have to say it's alimony, but it cannot say it's not alimony. In the case of this legal separation or divorce taxpayers, the spouses cannot live together when the payment is made. That happens sometimes. Don't ask me. I don't understand it, but it does. The payments cannot continue after the death of the person receiving the alimony. So, what does not qualify as alimony? Property settlements. So, when you're dividing up your property, that is not alimony and it's not even taxed. Child support payments fixed by the divorce. So, sometimes in a divorce or separation agreement, it'll say, this spouse, one spouse, will pay the other spouse $1,000 per month. It doesn't say it's not alimony. It doesn't really call it anything. But here's what the qualification is on it. When child reaches 18, the payment will go down to $700 per month. So how much is really the alimony portion of that payment? Well, obviously, if it goes from $1,000 down to $700 when the child reaches 18, $300 of that payment is child support. And child support is not considered alimony. It's not taxed to the recipient or deductible by the payer. So the true amount of alimony each month is $700. So you have to be careful of that. Excluded are prizes and awards. I'm sorry, prizes and awards. Prizes and awards are included in income. So you go on Jeopardy, you win 100,000, that goes on your tax return. You go on Biggest Loser, you lose all this weight, they give you all these cash prizes, a trip to Aruba. That's all income. Prizes, awards, they go on your tax return. What isn't though? You can only exclude a prize and award if you get it for a scientific, literary, or charitable achievement. And it's transferred to a qualified charity immediately. You never get it. You just say, I want it, that's great. Transfer it to this charity. So that's the first thing. So if it's a check made out to you and then you give it to the charity, that doesn't count. You have to direct it right to them. Also, you can't have done something. You can't have actively been looking to win this prize. It's just something that, like it's like the Nobel Prize. They just give it to you because you're fabulous. Okay. So you immediately transfer it to the United Way, non-taxable. Everything else you would include it in income and then deduct it as charitable deduction if you could. The next bullet point, and this is important for employees. Most employee payments of any kind are considered income, even if your employer calls it a gift. In taxes, they look at it as income, except if the prize or award is for an employee length of service or safety achievement, and it's a property item. $400 is the limit for non-cash property. So, and here's the other thing, so you know, and I don't think your book mentions it. It doesn't. Let me just double check something. They mention it in your little footnote, so you want to take a look at it on page 517, footnote 24. They don't put it in the reading, they put it in the footnote. This is important. It's $400 if it's what we call a non-qualified plan. So if your employer just comes up to you and says, "You're doing a fabulous job. Here's a watch." You know, you're doing a fabulous, or I'm sorry, you're doing a fabulous job and you haven't gotten hurt. You're like the only employee around who doesn't get hurt. This is for your safety achievement, and it's a $300 watch. You're cool. It's under $400. If they come up to you in the same scenario and give you an iPhone that costs $1,000, now you have to say, uh-oh, 400 is excluded of that value. The other 600 is income to you. Unless the safety or length of service is available to everyone. So if there's a policy that says if you achieve these items, anybody, you will receive an iPhone. Or if you're here for 10 years, anyone will get an iPhone. Now the value is $1,600. So if that award you receive is less than $1,600 and it's offered to everyone, the same award, then it's non-taxable. To Team USA athletes from U.S. Olympic Committee on account of their competition in Olympic and Paralympic Games. Now that's something new. Okay, so this is another award that is limited to what it's actually being taxed at. Now, if it does not, and if you look on page 5-17, right above where it says taxes in the real world, it says while there is no limit on the exclusion amount, the exclusion does not apply to a taxpayer. So somebody in this situation, if their AGI exceeds $1 million before the reward. Okay, so a lot of these people are making that kind of cash flow. But if they're not, they don't have to include the award in that situation. The next major item that is excluded from income is Social Security benefits. These benefits are taxed, they may be taxed up to 85%, but that's it. So if you have a taxpayer, a client, who is receiving Social Security benefits, never will, well, at this point, the law does not allow for 100% of those benefits to be included in income. Only up to 85% maybe. And there's a special calculation we do to determine the amount of taxable benefits. We first start with what's called modified adjusted gross income. And here's what we do. We take a person's AGI, their AGI. So there you go. There's that AGI. That's very important. Gross income minus deductions for adjusted gross income gives us AGI. You don't include any kind of Social Security, so you have to figure out adjusted gross income before anything with Social Security. We then add to that amount what's called the tax-exempt interest income. So it's not taxed, it's still not taxed, but for determining how much of Social Security is included in income, we add that to our AGI. And then we add in what's called excluded foreign income. So if we have any foreign income that is excluded from gross income, we add that in. And those are the two major items. So once we get that amount, we then compare it. We then compare it to base amounts. Now, these base amounts are, of course, they're not presented there. For a single taxpayer, if that computation that we just did, AGI plus foreign income plus interest income plus 50% of your Social Security benefits, if that amount is less than or equal to 25,000, none of the Social Security benefits are taxed. None of them. If you're single and the amount you computed is greater than 25,000 but less than or equal to 34,000, here's your computation. Some of your Social Security will be taxable, and here's how you compute it. It's the lesser of A. So first, 50% of your Social Security benefits. Or B, 50% of that modified adjusted gross income. So that's adjusted gross income plus tax exempt interest plus foreign income exclusion. So we take that plus 50% of our Social Security benefits. Okay. And subtract it from 25,000. After doing that computation, take 50% of it. The lesser of those two amounts Joint taxpayers have a different um, level, and that is on page 5-18. Theirs is 32,000 instead of 25, and for the first level, and then 44,000 for the second level. Okay, more items that are included in income. Imputed income. Certain employee discounts or low interest loans generate income via indirect benefits. So if you are given a low interest loan, the amount of it, or you provide, I'm sorry, if you provide a low interest loan, the amount of imputed income is the difference between the amount of interest using federal interest rates and the amount of interest the taxpayer actually pays. So what they're saying here is that you should take and determine how much you should be charging the person you loan the money to, and see how much interest you should be showing on your tax return, and compare that to what you actually are receiving and the difference you have to show as income on your tax return. The borrower is deemed to pay imputed interest. So it's like you actually did pay, you did receive it. And then the lender is deemed to have returned the imputed interest to the borrower. That's the way the IRS looks at it. Imputed interest rules do not apply to aggregate loans of $10,000 or less between the lender and borrower. So you loan your daughter $8,000. I mean, most relationships like that, they're looking at it as a gift. So, isn't that nice? The next part is discharge of indebtedness. And this is when a taxpayer's debt is forgiven by a lender. So this is one situation that when you take a loan in the future, if the lender says, don't worry about paying that back, that part of the loan will be included on your tax return. There are some exceptions. If a taxpayer, though, is insolvent, so their liabilities exceed their assets, a discharge of indebtedness then is not taxable. If the discharge of indebtedness makes the taxpayer solvent, the taxpayer recognizes taxable income to the extent of his solvency. So what they're saying here is that if you're in a situation where you just cannot pay your bills, and they're trying to make you equal so that you don't have to file bankruptcy, they're not going to make you pay tax on that. But if you are in a situation that it's your assets, you have the money to pay it, and they're still forgiving a part of your loan, you're going to put that on your tax return and pay income on it. Now, Congress allows certain types of income to be excluded or deferred to help subsidize or encourage particular activities, and also to mitigate inequities. One such item is municipal bond interest income. So bonds issued by your state and local governments in the United States, people who own them, interest income on them are tax exempt. So they are not taxed on the taxpayer's tax return. Another exclusion is the gain on the sale of a personal residence. So taxpayers may exclude up to $250,000 of their gain, single, $500,000 if they're married filing joint, of the gain on their sale of their personal residence. Now remember, you need to calculate your selling price minus selling expenses, and then subtract your cost basis, which would also include the original cost plus improvements, minus any depreciation taken. And normally we do not deduct depreciation on our home unless we use it for our business. So most homeowners are going to take original price plus major improvements as their tax basis. The difference, if it's less than $250,000, is not taxed. For a single person, married filing joint would be $500,000. If the difference is above that amount, then the first $250,000 for single, $500,000 married filing joint would not be taxed, and the excess would be taxed as a long-term capital gain. Now, I've had people ask, well, what if you flip houses? That's not your personal residence. Now you're in a business. So you have to satisfy certain ownership. You have to own the home at least and live in it for at least 2 of 5 years. At least 2 of 5 years. And there's some other qualifications. So we have to be aware of that. Certain fringe benefits offered to you by your employer are tax exempt. There's a whole list of them in a really nice chart. I like this chart a lot on page 5-24. And I'm going to go through them, although they mention them in the PowerPoint here, just to make sure, understand. These are called qualifying benefits, and when you receive them from your employer, they are not taxable. Medical and dental health insurance coverage. Life insurance coverage. So if you have what's called just went out of my head, group term life insurance through your employer, the premiums related to the first $50,000 of insurance coverage is tax exempt. Now, I have this. I think I have $120,000 of life insurance through LCCC. The premiums related to the first 50,000, I don't pay income tax on, but the premiums related to the amount above 50,000 in insurance coverage, so the other 70, I do include in income. I'm not including 70,000. I'm including the benefit, the premiums that has to be paid on that in my income. De minimis, small benefits. These are things that are so small, like using the photocopier, getting like a ham at Christmas, just little things that it's not worth tracking and including in income. Meals and lodging. Now, this is a big one. Meals for an employee can be excluded if their employer provided meals and they are provided on the employer's business premises, and they're provided for the convenience of the employer. Some examples. A nurse eating at the hospital cafeteria lunch so that she's on call if she's needed in an emergency. A waitress in a restaurant. So they're provided on the premise and they're there more for the convenience of the employer and less for the employee just to get a free meal. Lodging, you must I'm sorry, I'm going backwards there. For lodging, it has to be provided by the employer, of course, on the business premises. So the lodging is right there, and it has to be a required part of the job. So this is a very narrow group of individuals. This could be the park ranger at Yosemite Park. Okay, they have to stay in the lodge in order to take the job. So they have no choice. So these types of lodgings are tax exempt. If it's, oh, hey, hotel manager, we need you on call and we're going to put you up in an apartment down the street and pay for it. No. Nope, it's not on the premises. So we have to be very careful when looking at that. That would be a taxable situation. Employee educational assistance programs. So if an employer provides employees with education reimbursements, the first $5,250 of such reimbursements are tax exempt in a year. Qualified employee discounts. If the employer provides a service and allows employees to use the service without charging them, or I should say that not charging them at all, but they offer them this service at a 20% or less discount, that discounted portion is not taxable. If it's above 20%, it would be. If it's a product that they're offering, the discount cannot be greater than the gross profit on the item. For instance, let's say you work at Best Buy. Best Buy normally sells TVs for $1,000. That's the selling price. The cost of the machines, TVs, are usually $700. So, if you are offered by Best Buy because you're an employee a discount on the TV, if you're paying $700 or more still for the TV, any reduction in price is not taxed. But if you're paying less than the cost, the part between the cost and the actual amount you pay, so if you paid $500 for the TV, that cost Best Buy $700, $200 of that discount would be taxed. Dependent care benefits, employees may exclude up to $5,000 of these benefits provided by their employer to help care for their kids. Working condition fringe benefits. So if your employer provides you with, make sure that's the one, journals for your work, like I get the Journal of Accountancy. If I bought that on my own, I could deduct that as a business expense on my tax return. If my employer provides it for me, it's considered tax-free because that's something I could deduct anyway. If I included it in income, I could then deduct it. So it's ignored. So there are things for your job that would normally be deductible by you anyway, and your employer provides them. They're tax-free. Qualified transportation. Employees may exclude up to $255 per month for employer provided parking. So if your employer pays for your parking, and up to $255 per month for commuting in mass transit. So if you're reimbursed for any of those things, up to $255 a month is tax-free. Qualified moving expenses. We'll talk more about those, but if you need to move because of a job change, basically, those moving expenses that are covered by the employer are tax-free. A cafeteria plan, a plan where employees choose among various non-taxable benefits. They're generally non-taxable if the employee chooses non-taxable benefits as discussed above. And then there's the flexible spending account. This allows employees to set aside a certain amount of before tax salary to cover for payment of either health and or dependent care amounts. Okay, so you could read about that. But this is a great table. Really take a look at those. These PowerPoints don't justify how important they are and why we don't pay income tax on them as employees. And there it is again. So you could take a read through, post any questions you have about them. The education related exclusions. As an incentive for taxpayers to participate in higher ed, of course, Congress excludes certain types of income if the funds are used for higher education. For example, if you receive a scholarship for tuition, fees, books, and supplies, it's excluded. And it's only excluded if you didn't have to do something to get that scholarship. So you're not required to perform at the school, like teaching or do any type of special services for them. There's a limited exception for tuition waivers for student employees and teaching and research assistants. What this means is, for instance, myself, I'm a full-time employee at LCC. As part of my benefit package, my dependents can go to the school for free, tuition free. So when my son, who is a junior now in high school, he'll be starting school early as an early scholar, any kind of tuition related to LCC is paid for by LCC for him to go to school there, and I don't pay income tax on it. That's what they mean by a tuition waiver. So that's an exception to there. And it's usually for undergraduate work that there's tuition waivers that are non-taxable. But generally, if you have to work for your scholarship, like in a graduate program, it may be taxable, that scholarship. Also, scholarships related to room and board are taxable. So it's only scholarships for tuition fees, books, and supplies. Taxpayers are allowed to exclude from gross income earnings on special investments in qualified education plans, such as what we call 529 plan, and those are pretty popular. These are educational savings accounts, and you could save in two ways. You can purchase college credits at today's prices, and when the student is ready to go to school, the college will accept whatever money has accumulated as tuition. Or you can use basically a savings account. That's what I have for my son. And what I do is every month I put money into it. It's a 529 plan. It's invested in the stock market. And then when it's earning money, no, I don't have to pay any tax on that. I don't pay any tax on interest, dividends, or any gains. And when he takes it out to use it for qualifying educational expenditures, basically tuition and books, okay, then it's tax free. If and only if he uses it for that purpose. If he doesn't, then it becomes taxable to the extent of the earnings. Taxpayers can elect to exclude interest earned on special series educational savings bonds through the government when the redemption proceeds are used to pay higher education expenses. So I know my parents are big into this, and even I was when my son was first born. Go to the bank, buy an education savings bond. You buy it for $25 now. In 10, 15 years, it matures and it's worth $50. So that $25 difference from when you bought it to you cash it in is interest. So there's special rules here, and this doesn't do it justice either. If we take a look on page 526, what's important is in order for it to be excluded, the interest, it has to be used to pay educational expenses. But beyond that, this is important. The person who bought the bond had to be at least, I believe the age is 21 years old at the time they bought it. So the owner of the bond had to be 21. They had to have bought it after 1989. Okay, and there's one more thing. And it has to be paid for higher education. So what's happening is back then people would buy it and put it in the child's name. You can't do that. You have to leave it in your name. Okay? And then when it's redeemed and the child, the spouse, whoever, the dependent uses it, then you can exclude the interest income to a certain extent. You could exclude all of it if all of the bond proceeds are used for higher education. You would only be able to exclude a portion if it's only partially used. Now, if your AGI goes above a certain amount, some of the interest income may not be deductible or excluded. Some of the interest income may not be excluded, so you must keep that in mind. Congress also provides certain exclusions to eliminate potential double tax. Gifts and inheritances. Individuals who receive gifts or inheritances do not pay income tax on them. While receiving that is real income, the value of the gifts and inheritances is excluded because these are subject to another tax, gift and estate tax. Life insurance proceeds. If you receive an amount, a beneficiary receives an amount due to the death of the insured, that amount is excluded. If the proceeds are paid over a period of time rather than in a lump sum, any interest portion must be recognized as interest income. Give you an example. Somebody passes away, you're the beneficiary on a life insurance. Instead of taking the $100,000 life insurance policy proceeds up front, you say to the insurance company, pay it out over 5 years. You receive your check the first year. It's $25,000. Well, $100,000 was the original amount of your proceeds. 5 years, you should receive $20,000 of life insurance proceeds a year. So that $25,000, $5,000 of that is interest income. It's that portion you recognize on the tax return. Now, if a life insurance policy is transferred to another party for valuable consideration, so basically you sold it to someone, then it's not excluded. Or if a taxpayer cancels the life insurance and receives proceeds in excess of the premiums they paid. For instance, let's say you have a life insurance policy. Over your life, you have paid premiums of $50,000, but you cancel it and you go, just give me the value of it. Well, you get a check from the cancellation of $60,000. Well, not all $60,000 is included. You would subtract the premiums you actually paid of $50,000 and you would include in income $10,000 of it. That's what they're talking about there. Now, there are certain exceptions to this early cashing in of life insurance, and that's what we call the accelerated death benefits. And here's what they're talking about. If a person is terminally ill, and terminally ill is defined as you will be dead within 2 years, certified by a doctor, you can cash in or sell your life insurance policy and none of it's taxed, and you could use it for any reason. Some life insurance policies hold these. I had an uncle who did it. He had terminal lung cancer. Him and his wife cashed in the life insurance policy and then enjoyed the money while he was still alive. Why not? If you could afford to do it, do it. Now, it also applies if you are chronically ill. So you have to be medically certified chronically ill. That means you cannot, you need assistance to do daily living. You need someone to help you with just daily living. You can also do this accelerated benefit. So you can basically cash in your life insurance policy to pay those bills. But that's the key. You have to pay the bills with those proceeds. You can't go and take a trip around the world. Then it would be taxable. But if you're terminally ill, oh yeah, you could take a trip around the world. There's no restrictions on how you use the money. Foreign earned income is another exclusion. And we talked about this when we were talking about Social Security a little while ago. If you are a United States citizen who works in another country, you need to file a tax return in the United States. So you can't say, well, I don't live there anymore. No. You file a tax return here. You may also be required to file a tax return in the foreign country. So to prevent you from being double taxed, one exception, one allowance here is that you can exclude up to $102,100 of your foreign earned income on your tax return. Now you have to be eligible to do this. And the third bullet is your eligibility. The taxpayer must have had her tax home in a foreign country. So you lived in the foreign country. And to be considered a resident of that foreign country by living in the country for the entire year or 330 days in a consecutive 12-month period. So you're not being sporadic with how you live there. You live there. That's your new home. But because you're a U.S. citizen, you had to file a tax return in the United States. So they don't want to tax you twice. Take a look at this example. Courtney is considering a transfer to EWD's overseas affiliate where she will be paid $120,000 annually. Assume that her 12-month qualifying period includes only 200 days in the first year, 140 days in the second year. How much of her expected $65,000 salary can Courtney exclude? Well, the maximum would be the 102,100. So in order to get the full 102,100, those are the qualifications. You would need to allocate the 102,100 max by the 200 days over 365 days. So the most she can exclude is $55,945. So she still gets an exclusion, but only for the amount of time she actually lived in the country. If you live there at least 330 days, your maximum is 102,100. Sickness and injury related exclusions. Workers' compensation. Remember, workers' compensation are payments you receive when you are hurt at work. These are excluded from gross income. Your employer pays the premiums on this insurance policy. They keep the insurance policy and they utilize it when employees are hurt at work. It is tax-free to the person receiving it. Payments awarded with associated with personal injury. Now these are lawsuits. So awards that relate to physical injury or sickness, or are payments for medical costs of treating emotional distress, are excluded from gross income. So there's two major types of awards. There's compensatory and there is punitive. That's what we're talking about in the first bullet, are compensatory damages. Compensatory damages bring a person back to being whole from the damage. But these compensatory damages have to be from physical injury or sickness or treating emotional distress, medical costs. Not the award is for medical or for emotional distress. It's the award is for the medical costs associated with treating that emotional distress. Any other payment awarded is taxed. So compensatory damages for emotional distress or any emotional mental item, and any punitive damages. Now, punitive damages are damages awarded for punishing the person who did you wrong, did the taxpayer wrong. So they're usually added above compensatory damages. They're all taxable. Healthcare reimbursement. Reimbursements by health and accident insurance policies for medical expenses that are paid by the taxpayer are excluded from gross income. So you're just getting your money back and they're not taxable when you get that money back. Disability insurance. This is also called wage replacement. This pays the insured individual for wages lost while the individual misses work due to injury or disability. And these injuries or disability are caused by non-work related actions. So you're at home on a ladder, fall off, break your ankle. That's when disability, and you can't work. Well, now disability insurance will kick in. If an individual purchases the policy, so they're the ones paying the premiums on this insurance policy, they are excluded. Any benefit received is excluded totally from gross income. But if it's the employer who purchases the disability insurance and the individual excludes the benefit from her compensation, then the disability benefits are taxable. So here's what we're talking about. I'm at home, I'm on a ladder, I fall off the ladder. I call my insurance company that I personally bought a disability insurance policy on and say, I can't work, I got my disability, it kicks in, I start getting money. None of it's taxable. Same scenario, fall off the ladder, break the leg, can't go to work. Go to my employer because they're the ones who purchased the disability insurance policy and pay the premium on it, and those premiums were paid tax-free to me. I tell them I can't work, I need to go on disability. They say, okay, the insurance kicks in, I get disability benefits. They're 100% taxable to me. So we got to be careful there. The final area, deferral provisions. So this allows taxpayers to defer, but not permanently exclude, the recognition of certain types of realized income. Installment sales, which we'll talk about in future chapters, these are sales where you have a gain, but because the way you're receiving payments on the sales, all the gain is not taxed in the year of the sale. Another thing is like-kind exchanges. I don't know if we'll get to that or not. Involuntary conversion. So this is something is destroyed, it's not your fault, and you earn some money on it. And contributions to non-Roth qualified retirement accounts. So we're talking about IRAs, individual retirement accounts. We're talking about 401ks there. And we've already discussed that in detail about how contributions into these types of retirement plans, the money is not taxed now as you put the money in and actually earn the money to put it into these funds. But when you take the money out at retirement, it is taxed. So some of these items we will be looking at in more detail later. So this was a great chapter and a long chapter on all of the various items that, first of all, hey, everything's included in income. But here's the things that are totally excluded, only partially included, or deferred. And we have to remember these rules associated with them. So post any questions you may have to the discussion board.